You passed the challenge. You hit every target, followed every rule, stayed disciplined the entire time, and the prop firm handed you a funded account. Then within 2 weeks, maybe even 2 days, you blew it. Not because you suddenly forgot how to trade, not because your strategy stopped working, because the market you traded during the challenge was not the same market waiting for you on the other side of that evaluation. The challenge protected you from something you did not even know existed. And the moment that protection disappeared, liquidity ate you alive. Most traders think liquidity just means volume. They look at a busy chart, see thousands of candles printing every hour, and assume the market is deep enough to handle anything they throw at it. That assumption is one of the most expensive mistakes in retail trading. Liquidity is not just about how many contracts or lots are being traded. It is about where the orders are sitting, who placed them, how large they are, and what happens to price when a move is engineered specifically to reach those orders and trigger them. Large institutional participants cannot simply enter a position the way a retail trader can. If a hedge fund wants to buy 2,000 contracts on a currency pair, they cannot just market buy and expect a clean fill. That order would move price against them before half of it was filled. So instead, they engineer the conditions that bring liquidity to them. They need a pool of resting orders at a specific price level, and they need price to visit that level so the orders get triggered and absorbed into their position. Those resting orders are yours. They are every retail trader's stop loss sitting just below a swing low. They are every breakout trader's entry order sitting just above a resistance level. They are every range trader's limit order clustered at a round number. Institutional players know exactly where retail traders place orders because retail traders are predictable. They follow the same technical analysis taught in every free course, and those patterns create liquidity pools that institutions can see, target, and use. The challenge environment masked this reality because of how it was designed. Most prop firm challenges run during high volume sessions with tight spreads and relatively stable conditions. The evaluation period often coincides with normal market hours, where price behavior is more controlled. Your stop losses were getting hit at reasonable distances, and your entries were filling cleanly. The market was cooperating, and you read that cooperation as confirmation that your edge was real. What changed the moment you went funded was not your psychology, though everyone will tell you that is the problem. What actually changed was your relationship to real capital and the firm's relationship to your trades. Many funded traders do not realize that the rules quietly shift after the challenge. Maximum daily drawdowns stay the same on paper, but the way price moves around your positions can feel completely different. You are no longer in a simulated environment where the firm benefits from you passing. Now they are exposed to your wins, and the market is fully real. Liquidity voids are one of the main reasons funded traders get destroyed so quickly after passing. A liquidity void forms when price moves through an area so fast that very few orders were actually transacted in that zone. The candle looks normal on your chart. It opened, moved, closed, and you placed your trade based on what you saw. But the area price moved through had almost no actual order activity. When price returns to that zone, and it often does, there is nothing there to slow it down or support it. Price shoots straight through your stop as if the level you marked was never relevant at all. Imbalances on your chart are essentially maps of where liquidity is missing. Every time you see a large impulsive candle with a gap between the high of one candle and the low of the candle 2 positions ahead of it, that is an imbalance. Smart money concepts traders call these fair value gaps. Order flow traders call them inefficiencies. What they actually represent is a record of where price moved so aggressively that the market never had a chance to properly match buyers and sellers. The market tends to return to these zones to rebalance, and when it does, your position is often sitting right in the path of that rebalancing. The concept of stop hunts is not a conspiracy theory that retail traders invented to feel better about losing trades. It is a documented and logical consequence of how large orders need to be filled in a two-sided market. When a market maker or institutional desk needs liquidity, they need price to reach the area where retail stops are clustered. Those stops, once triggered, become market orders that flow into the institutional position and allow it to be filled at scale without catastrophic slippage. The retail trader experiences this as their stop getting hit right before the market moves in the direction they originally anticipated. You have probably had this experience hundreds of times without understanding the mechanism. You place a trade, set your stop below the last significant low, and price drops exactly to your stop, triggers it, then immediately reverses and runs in your original direction for 200 pips. You think you got unlucky, and you think your stop was too tight. You raise it on the next trade, give it more room, and the same thing happens again, only now your loss is larger. The problem was never your stop placement in terms of distance. The problem was that you were placing it exactly where every other retail trader places it. That is precisely the area that needs to be cleared before the real move begins. Equal highs and equal lows on a chart are arguably the most important liquidity concept a funded trader needs to understand. When price creates two or more highs at nearly the same level, every retail trader trained in technical analysis sees that as resistance. They short it, place their buy stops just above it, and set alerts at that level. The cluster of orders sitting above those equal highs is so thick and so predictable that it functions as a magnet for price. Institutions know that sweeping above those equal highs will generate the liquidity they need to fill short positions at premium prices before driving price lower. The same logic applies to equal lows. Double bottoms, triple bottoms, and any area where price has bounced multiple times creates a dense cluster of stop losses and sell orders just below that level. When conditions are right and institutions need to fill long positions, price gets pushed below those lows, absorbs all the sell orders and triggered stops, and then reverses sharply upward. Understanding this changes how you read a chart permanently. You stop seeing resistance as a ceiling that price cannot break. You start seeing it as a pool of orders that price will eventually be used to collect. You stop seeing support as a floor that will hold. You start seeing it as a concentration of stops that will likely be cleared before any real continuation upward begins. This shift in perspective is not pessimistic. It is accurate. And accuracy in your market model is the single most valuable thing you can have as a funded trader. Session timing is directly tied to liquidity, and it is another dimension that destroys funded traders who pass their challenge by trading at all hours. The London Open, which begins around 2 in the morning New York time, is one of the highest volume transitions in the entire trading day. As London comes online, massive institutional order flow enters the market, and price often makes a sharp move that sweeps the liquidity built up during the Asian session. Asian ranges tend to be tight and controlled, building up clusters of orders on both sides. London players come in with enough capital to break that range, collect the stops on one side, and then establish the real directional move for the session. The New York Open amplifies this even further. The overlap between London and New York from roughly 8 to 11 in the morning New York time is where the highest volume and most aggressive liquidity engineering happens. If you are trading outside these windows, your strategy's edge essentially disappears. Many traders pass their challenge by accidentally trading good sessions and blew their funded account by continuing to trade bad ones. The kill zones are not just arbitrary time windows that someone invented for content. They are periods that align with the opening of major financial centers, the release of economic data, and the participation of the largest pools of capital. Your technical setup inside a kill zone has a completely different probability profile than the same setup appearing during a low liquidity period. The market structure is more reliable during these windows because there is enough real order flow to sustain directional moves rather than random noise. Premium and discount arrays are how liquidity and price levels connect into an actual trading framework rather than just theory. When price is trading above the equilibrium of any given range or swing, it is in premium. When price is trading below equilibrium, it is in discount. Institutions buy in discount and sell in premium. They are not buying breakouts, and they are not selling breakdowns. They are fading retail traders who do exactly those things. They use the liquidity generated by breakout entries and breakdown entries to fill their own opposing positions. If you passed your challenge by trading breakouts, this is critically important for you to hear. Breakout strategies work during challenges because the evaluation window often captures trending conditions where momentum carries price far enough past the breakout level to generate a profit. In a fully funded account traded across a longer time horizon, breakout entries routinely get faded immediately after your entry. The breakout itself generates the liquidity that institutions need to enter in the opposite direction. You were winning during the challenge not because breakouts are reliable, but because the timing happened to work. Order blocks are the institutional equivalent of what retail traders call support and resistance, but the mechanics behind them are completely different. Understanding that difference explains why your supply and demand zones keep failing in the funded account. A retail support zone is typically drawn at an area where price bounced in the past. The assumption is that buyers who defended that level before will defend it again. An order block is drawn at the last candle before a significant impulsive move, because that candle represents where an institution entered a position so large that it moved the entire market. When price returns to that candle's range, the institution is adding to their position or defending the entry. That is why price actually respects that level, not because of retail memory, but because of ongoing institutional interest. Mitigation is the process by which an institution returns to their order block to neutralize remaining exposure from their initial entry. If a large buy order was placed at a specific price and the market moved up sharply, the institution may have open exposure that needs to be managed. When price pulls back to that level, they are actively participating to either add more long exposure or reduce risk on the original position. Understanding this means you can align your entries with institutional activity rather than against it. Funded account traders who survive long-term all share one specific habit that most losing traders never develop. They wait for liquidity to be taken before entering. Rather than entering when a level is approached, they wait for price to sweep the liquidity sitting at or beyond that level. Then they look for a shift in market structure that confirms the sweep is complete before entering in the direction the market is most likely to move. This means they miss the very first part of the move. It means they are never the one who catches the absolute low or the absolute high. But it also means they are not the person whose stop just got hunted to provide someone else's entry. That trade-off is not a limitation. It is a professional standard. The transition from challenge to funded is not a psychological challenge at its core, even though that narrative is everywhere. It is an education gap. The challenge tests your ability to follow rules and manage risk within a constrained window. The funded account tests your ability to understand why price moves and align yourself with the participants who are actually driving those movements. Those are two completely different skill sets, and most traders enter a funded account having only developed the first one. You passed the challenge because you showed discipline. That discipline matters, and it should not be dismissed. But discipline applied to an incomplete market model will produce discipline losses. The traders who retain their funded accounts and scale up their allocations are the ones who stopped asking where price might go. They started asking where liquidity is sitting, who needs it, and how they will come to collect it. They study what price action looks like in the moments just before and just after that collection happens. That question, asked seriously and answered through real screen time, is what separates traders who pass the challenge from traders who actually build something from it. Liquidity is not a concept you learn once and move on from. It is a lens that changes every single thing you see when you open a chart. The levels you used to see as support become areas you now recognize as clusters of resting stops waiting to be triggered. The breakouts you used to chase become moves you now identify as engineered sweeps designed to fuel institutional entries in the opposite direction. Every part of your analysis gets rebuilt around a more accurate understanding of why price actually moves. The funded traders who flame out within the first month almost always share the same story. They traded the challenge on a demo-adjacent mindset, hit their targets, received their capital, and continued doing exactly what worked before, without questioning whether the conditions that made it work still existed. The market does not care that you passed. It does not reward consistency in a vacuum. It rewards alignment with the forces that are actually moving price, and those forces are institutional, not technical. There is a reason the best funded traders spend more time studying sessions they did not trade than sessions they did. Reviewing trades you took tells you whether your execution was clean. Reviewing price action during sessions you sat out tells you whether your model of the market is accurate. If price does exactly what liquidity theory predicts during a London Open you watched from the sidelines, that is confirmation that your framework works. If it does not, that is information you need to refine your understanding before you put capital at risk. The prop firm is not your enemy, and the market is not conspiring against you personally. The market is a mechanism for transferring money from participants with incomplete information to participants with more complete information. When you enter a trade based on a textbook technical pattern without accounting for where liquidity sits and who needs it, you are the participant with incomplete information. The funded account does not change that. It just raises the stakes until the gap in your education becomes impossible to ignore. You passed the challenge. That took real work and real discipline, and you should not minimize what it took to get there. But passing the challenge was the beginning, not the destination. The funded account is where your real trading education starts, and liquidity is the first and most important subject on that curriculum. Learn it deeply, apply it consistently, and the market that once destroyed your funded account in 2 weeks becomes the market you finally know how to read.